According to statistics from JPMorgan Chase Co, investors are purchasing some of the world's poorest countries' bonds at such a rapid rate that their risk premium is now declining at the fastest rate since June 2005, when compared to peers with investment-grade ratings. And countries like Pakistan, Ghana, and Ukraine, which were just a few months ago teetering on the verge of default, are driving this high-yield rally. Now, Victor Aluyi, Senior Vice President and Head Investment at Sankore Global Investments, joins me now to look at this interesting development. Victor, this is really an interesting turn of events, especially for those countries like Pakistan, Ghana, and Co. that have been sort of on the edge of default, and we've talked about that in recent times. So how did things just quickly change or turn around for them like this?
So how I look at it is I don't see this as things changing. I just see what's going on as largely opportunistic and, quite some speculation going on. A bit of a background, recall that, we're essentially on an interest rate hiking binge across the world, particularly the developed world. And the reason for that really is to try and combat, decade high inflation, inflation at the highest point in 40 years across, the developed world. So clearly yields in the developed world will continue to expand, and with it will drag along, emerging market yields. What this has done is just to make these emerging market yields look attractive. However, it doesn't take away the fiscal weakness, that will certainly emerge. So, through COVID, a lot of countries essentially borrowed their way through that period to ensure that they were able to stave off the worst of the impact of COVID. Right. And it made sense to do that at the time because interest rates were next to zero, particularly in the developed world. And even in emerging markets, you had single digit interest rates. Today, interest rate, particularly across the emerging market world, is in double digits. To put on top of that, the increased debt that we've seen over the last 2 years, it creates very significant fiscal challenges that emerging markets will have to deal with, along the way. So whatever move we're seeing now, I don't really think that it is sustainable because there are strong fiscal questions to be answered. If you look at the posture of the rating agencies and what has happened over the last couple of months, we've seen ratings downgrade for, quite a number of emerging market countries, with these rating agencies citing, these fiscal challenges that they are likely to face going forward. So whatever it is that we're seeing now, I think is largely speculative and really not sustainable.
That's really what a lot of people have described it as an unsustainable distortion. But you, of course, talked about the risk and the fiscal pressures that remain. When you look at countries like Nigeria and Egypt, their dollar debt yields have fallen since late October to about 13% and 12%, with the risk of distress still being highly priced in. So how is this risk of distress continuing to weigh? Even in Ghana, that might be one of the countries right now gaining from this situation, the default risk and the distress risks still remain very real. So how is that risk being priced in right now to what we're seeing?
Right. I mean, so the move that you've seen in Nigeria, for instance, and probably Egypt over the last couple of weeks has just been a case of a rising tide lifting all boats. So, global risk sentiment has been strong, particularly coming off the back of the last CPI print from the US, which came in at 7.7%, significantly lower than expectation. That created a bout of significant positive risk on sentiment in the global markets. And with it, we saw, emerging market debt also move, and that has created some strong move there. However, if you look at a country like Ghana, for instance, it didn't benefit from that move. As a matter of fact, if you look at where, the Ghanaian dollar yields were maybe 2 months ago, they are worse off than they are now. We haven't seen much move there. Yes, there's the conversation that is going on with the IMF. Maybe that has created another sector of uncertainty that has, pushed the market to price that uncertainty in, such that the yields for Ghana really haven't moved over the last couple of months. But the move that we've seen in Nigeria and in Egypt, for instance, are not idiosyncratic. They are basically linked to moves that we've seen, from a global perspective, a risk-on global perspective that has basically lifted, these yields over the last couple of weeks.
And it's interesting you say that rising tide lifting all, because when we look at it, there is the prospect for this slower pace of interest rates that looks more likely in the few days we've had, in the few weeks since the U.S. Fed did its last interest rate hike, and we've seen investors return. But everyone is not as attractive as everyone else. So even if it is an unsustainable trend, it is a tide that's rising or lifting everyone else. Who's topping the tide, particularly for African countries, and of what benefit really is it to them?
So, so what has even happened over the last couple of days is that you've had a couple of Fed officials that have come out to speak that have, I would say, essentially kind of doused the pressure. If you look at the market Thursday, Friday, and if you look at it this morning, all of that positive risk-on sentiment is beginning to fade away. Now, the Fed is basically saying that where the rates are, they are not in significant restrictive territory. So with interest rates can be restrictive, accommodative, or neutral, right? So restrictive basically in a region where they restrict growth or they slow down growth, accommodative in a region where they help growth, neutral where they really do nothing. And the Fed perceives that we are basically at the height of being neutral right now. So clearly there is that possibility of even greater rate hikes. I mean, the St. Louis Fed President James Bullard guided to a 5 to a 7% terminal rate for the Fed funds rate. So all of that has basically taken out some positive sentiments in the market over the last couple of days. And I expect that will continue until we see the next CPI print, which isn't due until about 2 weeks from now. That next CPI print will prove crucial in really determining market direction. Recall that all of this positive sentiment has been on the back of that positive CPI print that we saw just about 2 weeks ago. Also, sometime in July, we had a positive CPI print, which saw markets essentially getting ahead of themselves with a lot of exuberance. And the next CPI print basically showed us that inflation had not peaked. And then the market essentially created after that. So it would take a couple of CPI prints for us to get a sense of, inflation peaking and inflation starting to come down, and how that would then impact the clip or the rate of hikes by the Federal Reserve Bank, going forward. See, it's going to be really data dependent, and whatever you see now might not be sustainable.
Quickly before I let you go, you did mention the credit ratings agencies, and we've seen that in Africa, the Middle East, Latin America, and the Caribbean. Moody's Investor Services says more than 50% of sovereigns are currently rated B or lower. Just very quickly, in the longer term picture we're looking at, and you've of course talked about the next couple CPIs, what does that really mean, particularly for African countries? We had an S&P conversation, which they've put South Africa now a positive outlook, but generally we're seeing some interesting times for the sovereigns.
It's a mixed bag, really, right? So for commodities exporting emerging market sovereigns, I think they stand to benefit a bit from this because you're seeing commodity prices remain sturdy, even at the fact that we're going into a global slowdown. I mean, oil prices at almost $90 a barrel, is really, really decent for commodity exporting countries. However, for emerging markets that really don't export any commodities, this will be a very, very difficult situation for them. And I think that's where a country like Ghana finds itself. A lot of emerging market countries had racked up quite some debt over the last couple of years. And now, we're moving into an environment where interest rates are certainly going to be higher. The burden of repayment, of course, is going to be higher. If you're not earning more revenue than you were a couple of years ago, it puts you in a really, really difficult fiscal situation. So that's what we're going to face going forward, really.
All right, so we'll be keeping an eye on it, and we know you will as well. Victor Aluyi, thank you as always for joining me.
Thanks for having me.